A lot of traders think they have to be perfect in order to make money, or they have to take a perfect trade, buying at the low, selling at the high, in order to see the best profits. And in this video, I'm going to talk about how we should not try to be perfect and why it's better to aim for imperfection in order to see profits, make money, and be consistent in our trading. Now, a few weeks ago, I posted on my Instagram about the avoiding the fear of losing. And this video is going to be a psychological one about how trying to be perfect ingrains fear in our mind on not trying to lose and trying to win as much as we can. And it also ties into having a trading strategy and a plan with implementing proper risk management while leaving our emotions out of it. And this video is going to tie it all together. I'll post a link in the description below if you do want to follow me on Instagram at Entrepreneurship. I definitely recommend doing so. This is my only Instagram account. But going into the charts to tie this all together, let's first go over the pre-market plan. I post these every single day in the Discord, setups I'm watching, levels I'm looking out for, and potential trading scenarios. So this was on the S&P 500, and again, I want to go over my levels of interest. The first one was this 4159 supply zone. I have this marked as a line, but this is a zone. I just forgot to add the box. Along with 4130 supply, and we also have demand at 4083, or 4085, and 4071. What we were watching for was the market to remain in balance above 4085 demand, but below 4159 supply. And if we can create demand and get above 4130, we're going to see a test into 4159, and we're going to be watching to play longs into these levels. Again, areas of interest, and we must use price and volume to decide if we're entering this trade or if we're going to hold off, be patient, and wait for another opportunity. Now, how this ties into trading now that we have our levels on the chart is I want to go over something very simple that I see a lot of traders just brush off, or they don't think this way, and I think it prevents them from seeing success. So the first thing is less is more in trading. A lot of new traders especially think they have to learn every single thing in order to be successful. They have to know every single in and out of the market, why things move up, why things move down, and why that's key, or that is very key. But sometimes we're not going to know the answer to it. And sometimes we don't need to know the answer in order to make money. So less is more. The less trades you take, the higher quality setups that you do take is better than taking 100 different setups that are lower quality. Remember, less is more, and you must work smarter, not harder. You could work as hard as you want, but your work ethic and how hard you do work is not going to equate to more profits. You could sit and study all day long, but that does not equate to success, and that does not equate to profits. You must work smarter, and you must have a strategy that works for you while implementing the things I'm going to say in this video. And you don't have to be a perfect trader to make profits. Like I said, you don't need to know everything. You just need to know enough what's going to make you profits. And in my opinion, how I classify what a perfect trader is, and I fell victim to this when I first started trading as well. I'm not going to sit here, saying I'm perfect, that I'm a perfect trader as well. I just know what needs to get done for me to make profits, and I stick to that. And the two main functions of this is having an edge, having a process, having your system, and keeping your emotions out of it as best as you can while implementing proper risk management. These are the two most important functions in order to make profits and in order to classify yourself as a perfect trader, to know just the right amount of stuff that you do need to know in order to be successful, and then we could scale it up from there. Now, it's vital, it's very, very key for you to understand what you can and what you cannot control. Stop trying to know everything. Stop trying to figure out the market. You cannot control the market. We could wake up one day, right? The market is, before it even opens, we come up with our plans, we come up with our levels of interest, but we don't know what the market's going to do. I don't wake up and say, okay, the market's going to sell off over here. The market's going to rally up here. We're going to consolidate. I'm going to make $10,000 today. We cannot control the outcome of the market. Whatever is going to happen is going to happen. What we can do is react to what the market gives us. And we can also, very key, is control ourselves. A lot of traders, which I deal with, I talk with hundreds of different traders on a daily basis, the ones that fail are the ones that they cannot control themselves and they cannot control their emotions. They try to sit in front of their computer screens and they try to predict the outcome. I do not believe in predicting. I believe in reacting. If you try to predict, you're going to try to force something that is out of your control. However, if you react, you can put pieces to the puzzle together that what the market is trying to tell you and trying to portray to you, so you can figure out the picture before it gets displayed. You cannot control if the market's going to move in your favor. You cannot control pullbacks. You cannot control rejections, but you can control how you perceive these things. The main point to this of the equation is you can't control the market. You can only control yourself and your thoughts. The ones that try to control the market are the ones that fail. The ones that try and successfully control themselves are the ones that succeed. You could have a really bad strategy, but if you can control your emotions and your mind and how you take those trades, I can guarantee you could be successful. It's not the strategy, it's you. Remember, you do not need to buy at the low and sell at the high to make profits. No one is always and every single trade gonna buy at the best price and sell at the highest price. It's just not gonna happen. What you have to do is follow your plan and implement risk management. So going back to the pre-market plan, let's just say we got long when the market sold off into demand, some heavy selling pressure at this area, and we got long when we started coming up around 4085. So now we're long, hypothetically speaking, over here, 4085. Our stop loss is below 4070. We're risking about 15 or so points, and our target is about 45 points away at that 4130 demand supply zone. So long here at the oval, the market starts moving up. We're emotionally attached to this trade. We're looking at profit and loss. We're seeing, okay, we're up, $1,000 in 3 minutes. And then the market starts pulling back. We see now we're only up $100, $200. We keep getting a dip, and then the market starts coming up even more, and now we're up $3,000. We never hit our target, so we had no reason to sell. I only sell if my target hits or my stop loss triggers, and then the market pulls back and we start freaking out, right? Our emotions are going through the roof. We can't control how we feel, and what do? We stop out of this position when we break below where we entered. We did not hit our stop loss at 4070, but we freaked out because we saw red on our P&L. We didn't want to lose any more money. We had the fear of losing, and we wanted to protect ourselves as best as we can because our emotions try to be right and our ego tries to be correct every single time. So we didn't follow our plan. We stopped out of this position prematurely, and then this thing ran according to exactly how we wanted it to off of this demand zone from the pre-market plan right into 413 supply and right into 4159 supply by the end of the day. So the plan worked out perfectly, right? We had our levels of interest. The market did exactly what we wanted it to do according to the plan. But us as traders, this is what I mean about being a perfect trader, prevented ourselves from making money on this trade because we let our emotions do the trading. This is something that we can control. Meaning, if we followed our plan, we held this pullback, we never hit our stop loss. Remember, your stop loss is where your analysis is proven wrong on the chart. I'm just saying this example as a hypothetical example. I did not take this trade, but the market pulled back. And if we followed our plan, we would have had an awesome trade on this, straight from the levels posted in the pre-market plan and straight from what we wanted to see the market do and how we reacted to what price did at our levels of interest. So going back to the example here is we can control our emotions. We can't control what the market does. This very well could have kept selling off and we could have not even bounced that demand, but maybe we saw something to prevent us from getting long. That is something that we can control. We can't control what the market does. And remember, maybe we sell full position at 4130 and we miss out on another 20-point sell-off or a 20-point rally into the top supply zone. We don't have to be perfect to make profits. We don't have to buy down here and sell up here. We are perfect if we follow our plan and we leave our emotions out of it. That's going to bring me into the next point, is plan the trade and trade the plan. It's vital. If you do not have a trading plan before you enter a setup, you are going to struggle. You are not going to have longevity, and your trading is not going to be sustainable. Believe me. You must create a plan based off of your edge, based off your system, and these are your setups, and you must trade your setups. If you don't know what an edge is, or you don't have an edge, you have a lot of testing to do. I definitely recommend watching some of my videos as well, but you must have an edge in the market. This is something that you collect data that you know when you see X and you gain Y, and when we see Z, we're going to get a result, and that result is either going to be a win or a loss. It's you getting your signals when you react to something the market's presenting you. That's your edge, and that's your system. Just because the market is moving up does not mean you have to take the trade, and just because the market is moving down does not mean you need to take a trade. That is so key. I fell victim to this when I first started trading. I blew up accounts. I threw out unnecessary amounts of money because I would just trade because I saw the market moving down, I would be a bear. Or I saw it moving up, I would be a bull. In this example, let's just say we saw the market moving down here. We're not in long. We just see it coming down. We don't even know demand is down here. But a lot of people see the market coming down. We got heavy selling volume, not realizing we're in demand. They take the market short all the way down here, and they get destroyed by the market reverses just off the thesis that the market's coming down. Now, if you had an edge, you had a system, you had a strategy, you would not look to get short, especially when we're in demand, and especially just because the market is moving down. I think that is very key. You must take a trade only when the market presents your setup and your edge, and when you perceive opportunity. I don't care if it's 1 time a week. I don't care if it's 3 times a week. But if you're trading just to trade, you are going to struggle, and your account is going to get destroyed, and you're not going to build consistency. I came up with this quote. I think it's very important. I actually have it written on my desk. I don't trade the market to make money. I trade the market to trade my setups, because my setups is what makes me money. I don't trade to make money. I trade to hit my setups, because I know if I take 10 of my setups, maybe 3 of them are going to be losers. But I know the rest of the 7 trades is going to bring me long, consistent success and bring sustainability in my trading. There's no perfect setup. No action is going to be similar, the action may be similar, but it's never going to be identical. We've had tons of demand zone bounces. We've had tons of supply zone rejections. While some are going to be similar, nothing is going to be identical. So don't think you're going to find the perfect setup. You could have parameters to, figure out what common similarities of your perfect setups are. Maybe it's like a low day break inside of demand, or a high day break inside of supply, or, heavy volume in demand. That's a certain parameter of a setup, but not one setup is going to be exactly identical. Think of it like the fingerprints on our hands. They're similar to everybody else's, but it's not going to be identical. It's not going to be exact. Think of it like snowflakes. I remember when I was in 3rd or 4th grade, the kindergarten teacher was telling me that not one snowflake is identical to the other. It's the same thing with the market. They're going to have common similarities, but not one thing is going to be the exact same. Also, you must understand the worst which is going to happen before entering a trade. So kind of tying all this together, I want to go to this Apple setup on Friday. This was on June 3rd. This was a setup, again, that I posted in the pre-market plan. We are watching Apple below 147, as there was not much demand or not much support below this level into 145.40. And this could also help the market bears. So ideally, we had this 147 level that we were looking to short below. Hypothetically speaking, again, let's just act like we got short immediately below 147. Heavy selling pressure came in, stop loss above the high. So we're risking about 90 cents to make about $1.70. A little under 2-to-1 risk to reward. Not the best, but not the worst, right? The higher or the wider our risk to reward, the more times we could afford to lose. So before we enter this trade, we have to know what the worst is going to happen. And in this example, if we're short below 147, the worst that's going to happen here is the market's going to move above 147.90, and we're going to get out for a 90-cent loss. If we're trading options, we could go to the options chart and see what our premiums were when they were around this price, right? Our target's at 145.33. So before we enter this, we know the worst that's going to happen. Then the market starts selling off, right? We're automatically up about $1 on this position. Great trade so far. Now we're up about $1.60, $1.50. Then the market starts moving back up. Now we're red on the position, right? Our stop loss never triggered. We never hit the high, but yet we're red on this position. What looks like on the chart is not working out. It never hit our stop loss. We had absolutely no reason to panic. Just because the market's moving up does not mean you need to get out of the position. Never hit the stop. We're not attached emotionally. We can't control what the market's going to do, but we can control how we view this move. And how we view this move is my analysis is still not proven incorrect. My stop loss never triggered, and I have every reason to be in this trade. Then the market consolidates, and we still consolidate, and we start moving down, and we sell off with heavy volume right in our target. If we had proper emotions, we controlled ourselves, we would have had a really awesome winning trade on our hands. However, understanding the worst that could happen before entering a trade will enable us to trade with like this. Now, a reason why traders don't accept losses is they're trying to control every single outcome and they want to be right all the time. In this example, if you're trying to control this and not have a loss, you're probably going to freak out when you see this type of move and you're going to get out of this position. However, before I entered this trade, I knew I'm going to be wrong up here. Going back to the S&P 500 example, let's just say we got long, hypothetically speaking, down here at 4090 right here. Then the market moves up about 20 points and we start coming down, right? We start freaking out, and let's just say our stop loss was 4090, so about break even after it moved up 20 points. Our stop loss is right here, right? We don't stop out of this position because we have the theory that we are going to bounce. And yeah, this example worked. However, if you could collect data and get a sample size of 50 trades, I guarantee you if you do not sell when your stop loss triggers, you are going to incur such a larger loss. And this has to do with emotions because our ego wants to be right most of the time. We don't want to have a loss. We don't want to feel like a failure. And that's us trying to control every little outcome and wanting to be right. You can't avoid losses. I can't avoid losses. The best traders on Wall Street have losses. In one of my videos a while ago, I said, I always bring this example up. I was sitting next to somebody on Wall Street, a close friend of mine, took an $800,000 hit on the market. I think he was trading oil or gold that day. $800,000 loss in one day. The market closed. We went downstairs. We had a beer, and he was talking like nothing happened. You cannot avoid these losses. What you could do is how you perceive them, how you control them to make sure they're not larger, and make sure your wins are much larger than your losses because we don't want to have a big loss. His $800,000 loss is a very small perspective or a very small ratio compared to his wins. So we can avoid big losses by controlling our emotions and implementing proper risk management. What we could do is figure out the best way to manage our analysis if we are incorrect and make sure our loss is as small as possible. So I hope this helped by saying you don't have to be perfect to make money. We're going to make mistakes. I'm not going to sit here and say I'm a perfect trader. I make mistakes. My emotions get in the way. Even like last week, my emotions were awful. But we have to control our emotions. We have to have an edge. We have to have a system. And we have to implement proper risk management. You don't need to be perfect to make money. If you aim for perfection, you are going to struggle. Aim for imperfection, but imperfection to an extent that you're doing everything you need to do in order to make you money. So I'm going to end the video on that note. I hope it helped. I hope you enjoyed this video. Drop a comment, drop a like on this video, and definitely check out the links in the description below. I offer a very in-depth and educational course. Comes with access to the Discord at no extra charge. and there will be changes very soon. So I definitely recommend checking it out before the changes get implemented. But peace out.